Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, head of UK rate strategy, and I'm joined today by our global market specialists, Giles Gale and Nevruzi. So I think when we recorded Bondcast last week, we were looking ahead to the week ahead and we said it's going to be a really busy week. We had the ECB, the UK budget, we had US CPI, and in fact, it turned out to be a really busy week, but for really none of those reasons that I've just listed. Dan, let's start with you, because I think probably the US is where all of this market volatility began. And perhaps you can just give us a kind of quick overview on what's really happened since we recorded Bondcast last Thursday.
Right. Last Thursday, we pointed out that this week's inflation numbers would be a determinant for the Fed and just essentially leaving on the data what they would do 25 or 50 basis points. And looking back only a week ago, now it just seems like we're basically in a different world with all events that transpired over the weekend. And as every listener by now has probably read about and over again about the failure of a couple of US banks and worries about this contagion spreading globally have caused a lot of repricing in rates markets in the US. Just to give context to listeners who haven't been tracking it as closely, in the US we had moves that really like a single day moves that were only, you would have to go to like Black Monday on 1987 to kind of match the scale of a daily move, and that was just one day. We kind of repeated almost all that action for most of this week. Again, another example, these forward contracts that people can gauge where the central bank policy rate going to be. So let's just say the 3-month contract starting in September's time fell by 120 basis points in a single day, measured by like the SOFR contract. So these are truly, and I don't want to use that word very lightly, but truly unprecedented moves, especially in kind of like the modern era for rates. What does that mean? Essentially, is markets are expecting a sharp turnaround from central banks, expecting that these financial contagion worries might cause the central bank to kind of pause for a little bit and reevaluate. And alongside with that, we've seen very heavy steepening of the curve, a lot of rates being priced out. Basically, kind of point out, within a week, we've taken out, based on this morning's numbers on Thursday, about 150 basis points from the end of December. Curves are inverted, but even the inversion is not really materializing that much in the very front end, because not only markets are not really sure whether we would get a hike at the next meeting, we're pricing pretty sharp cuts from June and July onward. So it's a pretty peculiar looking curve right now. We have about a coin toss priced in for the next meeting, again for May, and after that it looks like markets are pricing at 25, 50 in rate cuts instead of hikes. So it really spells everything that a policy error would look like, or just maybe I shouldn't use policy error, but more so people generally have no clue what the next reaction is going to be. The Fed is in the blackout period. They can comment on macroprudential issues, of course, but they can't really comment on macroeconomic policy. So with that, we saw a lot of reaction over the weekend as the Fed released a new funding facility for banks. We saw the government, the FDIC, basically saying that they will backstop more deposits than what would have over the insured amount. So that did calm markets a little bit, but it still doesn't appear to have been enough. And we're kind of left in a limbo waiting to see whether financial stability concerns are going to take over precedence over inflation.
And so what, guns to your head, what would be your take on that for the Fed? Obviously, this is a very, bad timing, I suppose, for all the major global central banks to be having their meetings. And we're recording this on Thursday when the ECB have just made their decision, just held their press conference. So we will come back to that. But, it's not easy for any of them having to make what feels like major decisions against this backdrop of, concerns around financial stability and huge amounts of market volatility. So which side of the coin do you think the Fed will settle on? Are they more concerned about their financial stability right now or their fight against inflation?
Hey, we don't even need the gun to my head. We were pretty explicit on Monday with the...
I won't do that, don't worry.
We put out an update to our Fed call, basically a pretty dramatic shift. We had a 50 basis point hike previously. Now we've tapered it down significantly to no hike at the next meeting and a pause afterwards, and a pause to quantitative tightening too. That's one of those things that seem consistent with pausing the rate hikes, but we don't know. I mean, that is, I guess, the lower conviction part of our view, just to kind of lever in both of those points. Pause of rate hikes just to send a signal that we're worried the banking system is very important. And in reality, banking system and performance of banks is likely, does likely carry a lot more weight than the performance of, for the most part, non-banks, given how much, A, the Fed regulates them, and B, it is really the plumbing of the system. And people might not really, from what I've known in our conversations and from what I see on the internet, I just feel like people might not be fully appreciating the deflationary or disinflationary impulse that freeze in bank lending or bank activity could have to the economy. And that was one of our main lines of thinking behind our Fed call, right? Like, the Fed wants to tighten financial conditions. They were hoping to achieve a soft landing by spreading the pain of rate hikes more or less evenly throughout the economy. That never ends up being the case, but no one, I guess, has a foresight to say this will be the sector that gets impacted in advance. In hindsight, problems were looking more obvious, but that's always hindsight being 2020. So we're saying no hike, just to kind of allow them some time to reevaluate. And listen, if inflation doesn't fall and we continue seeing higher numbers over the next month, and conditions, or at least like banking conditions, stabilize, and we don't really have a kind of a full-blown systemic issue in the US, maybe they resume again later on in the year. However, I don't think we are in this world anymore where we could assume that we can just keep on going as if nothing happened. The tail end of those rate hikes, in our view, have been clipped on the upside, at least again, and this should have impact on inflation. Similarly with QT, I mean, is the banking system at a point where we have a severe or any form of reserve scarcity? We're not. But at the same time, QT does lead to a drop in bank deposits, and maybe at this time you want to take as much as action as possible to slow down that deposit outflow. So we will see. It's a pretty wide range of estimates that we've seen from the economics community, and the Fed unfortunately doesn't have the ability to guide us right now on policy reaction. Maybe even they haven't decided yet, because things are, by the time this podcast is out there, we might know so much more than we did now with respect to the the stability of the financial system. So I'm just going to leave it at that for the Fed. No hike, end of QT, and a pause for now, and reevaluate at future meetings.
Okay, I think you're right, Jack. We always record this pod and laugh and say, oh, there's going to be data tomorrow. So always, we'll know that by the time we listen. But it really does feel at the moment like so much can change in 24 hours or less than 24 hours even, that I think that's enough on the Fed this week. Thank you, Jan. So let's move over to Europe then, because obviously these concerns about financial stability began in the US, but spread pretty quickly to Europe early this week, despite kind of risk sentiment returning early on in the week. And perhaps you would say the ECB then had an even harder job, because they had to make a decision this week rather than having the benefit of an extra week. And like I say, a week feels a very long time in markets right now. I think we spent almost all day yesterday debating whether the ECB would hike or not hike. And it felt like a very close call in either direction. But in the end, they did go for the hike, 50 basis points. So what's your take then, Giles, on how they kind of delivered that today, and what their stance will be going forwards, I guess, now with a bigger eye on financial stability than we might have otherwise had?
First thing to say is that we agonized over it a lot yesterday, as you say. And of course, things did feel at moments yesterday actually reasonably desperate. And so, I'm sure that we weren't the only ones. It doesn't seem like the ECB had quite so much angst in this. I think that we were told that there were only like 3 or 4 members that didn't support the 50 basis point rate rise. So, and even as early as this morning, when of course we already knew that there was a certain ideas from the SNB and the Swiss bank regulator, and that had managed to stabilize sentiment on the banking sector in Europe. No, I mean, I came in and I was telling people I thought the ECB should not raise rates, and so I hope that.
I wasn't gonna say which side of the coin it fell.
No, I just hope
I was giving you cover there.
Too much with the listener, but no, I mean genuinely it was. But at the same time, I was always also delivering that with the message that I would be not surprised by a 50 or a 25 or
yeah.
And so it was pretty finely balanced. And then on reflection, I sort of changed my view over the morning just on the basis that it seemed like given reasonable market stability and just tactically, it seemed like validating the market expectations to a certain extent would make sense. But I think that we can accept that. I mean, this is something which we came back to again and again. There's this trade-off between monetary policy and inflation fighting. I mean, in the short term, regardless of what Madame Lagarde says, there might be, but I think over the long term, probably much less. But in the short term, maybe the more important question I don't think was quite asked was, which is more important? And for me, stabilizing markets is obviously the number one priority. And so the point that I was trying to make was the cost to waiting until May doesn't seem all that long. It's only 6 weeks after all. If you need to raise rates by 50 basis points, you can do it then. Is that going to destroy your credibility? Definitely not. But if things go wrong, then not having raised rates just before they did and having to U-turn probably isn't a bad shout either. Anyway, we know what's happened now, so there's no point overanalyzing all of that. But the sense from the meeting was actually it was admirably boring. And I don't think anyone really felt that was what we were going to get this morning when we came into the office. And it's that's a good result to reflect well, I think, on Lagarde and to a lesser extent on de Guindos for having achieved that. So we are left with pricing, which is essentially somewhere between a peak rate of 3 and 3.25 at this point, which broadly speaking seems about right. I mean, I think that the ECB would like to think that it could raise rates a little bit further than that because everything is going to go back to normal and they therefore just revert to something like the path that they had before. There was this addition of monitoring the strength of monetary policy transmission that was kind of added to their explanation of the reaction function, which I guess is, in a sense, a bit of a general escape clause. But I think clearly the message from them is, we would like and we expect to raise rates, but data dependency. We'll see where we are. We'll see where the forecasts are in 3 months' time. Does that mean 25 basis points in May? It might do. I think that will be mostly dependent at this point on financial market volatility.
And just to round off the ECB discussion as well, and partly inspired by some of John's comments. Inspired. It sounds a bit flattering. What about quantitative tightening Q2? Do you think this changes anything on their bond selling front?
No.
Okay.
I mean, I'll say very, very quickly though. I mean, we got the first week's data, the data from the first full week of quantitative tightening, and the gross purchases actually didn't drop at all. So maybe we haven't really been exposed to that yet. And maybe I should just round up with a couple of general observations about the market. I mean, I think at this point, the market, as we speak, the markets seem to be reacting reasonably sensibly. That is, it feels a little bit risk on. And I don't think that's particularly to do with the ECB's messaging, although they handled it well. I think that's much more to do with the sense that actually, potential, or the fear of disaster has been at the very least delayed, and so there is a better sentiment to calm that. Italy, I think that this idea that rates probably aren't going to ever reach 4% in this cycle, for example. I think that is a relief for credit in Italy in particular. I think that the lesson from what the US banks have gone through is likely to drive more ALM paying. So, I think that that's going to mean wider spreads for the time being. Going to be something that is asset swap spreads, something we get used to. And there's been a little bit of kind of strange behavior in the benchmarks. So, Euribor, which is term at this sort of term benchmark, being setting, it's been quite volatile compared to the much more rate benchmarks. But it's printed quite low compared to the overnight benchmark. And I think it's just worth highlighting that I think that could continue just as part of this sort of deposits switching towards larger banks, which tend to be panel banks, and therefore the panel banks being able to reduce the rates they offer on those. I think that will persist for a while to come.
Okay, that makes sense.
Anyway, enough on that. Let's talk about the UK. First of all, maybe we should start with what happened this week, which was the budget and the gilt remit and all of that. So maybe you could just walk us through the numbers.
Yeah, I mean, I think the budget became, well, maybe apart from mine and a couple of other gilt analysts on the street, the budget became a bit of a secondary concern this week. It kind of sort of dropped off everyone's radars, I think, when, with all the other volatility that was happening in the markets and all the other concerns. But nonetheless, it did come. And I think part of the other reason as well why perhaps it wasn't as much of a major event, and certainly as much of a major event as the other kind of fiscal events that we've had over the last 6 months in the UK, is probably that from a gilt remit perspective in terms of the issuance numbers, it came very much in line with consensus. And so to put some numbers on that, the gross gilt number that they will be issuing over the next fiscal year is 241, and we had 233. And really, if you looked at, we saw a kind of Bloomberg survey, M&I survey, those sorts of things. They all had consensus very kind of cluttered around that 233 number that we had. There was one or two outliers to the top side or the downside. But really, I think there was a fairly broad consensus around that kind of 230, 240 number. So the overall issuance number is very much in line with what the market was expecting. We've long had this bearish view in gilts that has been kind of driven by this very heavy supply outlook and then the lack of offsetting demand. But we never really expected this week's budget in particular to be the catalyst necessarily for a kind of big bearish shift. I mean, notwithstanding the fact that there was a major risk-off move going on at the same time as the budget, although we did actually see gilts underperform a little bit. I think that the weight of or the impact that supply is going to have on yields is much more than just the announcement effect of the budget. This is about a kind of gradual shift lower in yields as this supply comes on board. So I'm not surprised that we haven't seen kind of a major sell-off towards our kind of 4.3% target, say, in 10-year gilts. But I do think that the budget this week confirmed the very heavy supply outlook, and also confirmed the kind of upside risks to supply to come. This is a multi-year step change, if you like, when it comes to the issuance outlook for the UK, and that is going to weigh. The other important thing, well, I guess the two things that we were looking at more closely in the budget, which we've spoken about loads on this pod, was the extent to which they might look to offset funding via gilts via other means. Well, that was basically a damp squib for all the time that we spend talking about this and writing about this. I think they're raising less than 15 billion in total via bills and NSNI. So they put that to bed a little bit, although DMO did later say that, the bill stock will be flexible throughout the year, but the net contribution to financing will be very small. But probably the other kind of major market mover, particularly on the inflation-linked bond side, was this skew of issuance between the buckets, between the shorts, longs, the shorts, mediums, longs, and linkers. So we were expecting quite a big shift away from longs and linkers, largely driven by a lack of demand from the kind of natural buyers of those bonds. And that was broad consensus, but I think we were expecting a bigger shift than most. And that shift didn't really materialize. They'll still be low, I guess, proportionally of the overall issuance number compared to history, the longs and linkers bucket. But obviously, like I say, this is a big issuance number still. So the kind of notional amount of issuance will still be very high, which although means that the kind of gross gilt number came in line with consensus, actually the duration that will be issued to the market will ultimately be slightly longer probably, or slightly bigger than we were expecting, given that skew towards longs and linkers. And I think this is, the market took it perhaps particularly negatively on the linker side, especially because they announced one more linker syndication than the market was expecting. And syndications are usually considered kind of big duration events. But also, interestingly, which I think probably goes against most expectations, is that a linker syndication will be held as soon as April. So we had assumed that even though they'd had one more syndication, they might backload those syndications into the end of the fiscal year, when, if there's more clarity on the kind of regulatory landscape for pension schemes and LDI, that their demand, and they are the kind of natural buyers of long end bonds and index linked bonds in the UK, their demand might return, but that may well be at least a couple of months away. So I'd sort of assumed that they would backload those syndications, but it doesn't seem like they are. It seems like they're kind of hitting the ground running with the linker syndication. So I think that weighed particularly heavily on index linked bonds yesterday in the UK.
Okay, and next week we also have the Bank of England, of course. I guess, are we just expecting them to be reasonably sanguine about the risks of financial contagion and just go right ahead and raise rates there, 25 basis points you've been talking about?
Yeah, I think so. I mean, it feels anyway like concerns around financial stability are certainly less in the UK right now than we've seen in Europe and the US this week. And there doesn't seem to be obvious signs of contagion to the UK that I think would make the Bank of England change their mind on a 25 basis point hike. It feels to me like the macroeconomic arguments for hiking still outweigh those concerns around financial stability, and particularly in light of the ECB kind of going ahead with their hike today. I think had the ECB not hiked today, it might kind of lessen the case for the Bank of England kind of ploughing ahead next week. But with the ECB going 50 and as of now, limited signs of financial contagion, I think that it makes sense for the Bank of England to go ahead and hike 25 basis points. Listeners will know, though, that we have long thought, before the volatility of the last week, that would be the peak in bank rate. So it is going to have to come about with likely some change in language, perhaps similar to what we saw from the ECB today around, perhaps a degree of symmetry around the direction of travel of rates in the future around, they could hike or cut. And perhaps they could kind of signal that they think this is a peak through the vote as well. So don't forget, this won't be a monetary policy report meeting for the Bank of England. So it's a bit different to the Fed and the ECB. So we only have the minutes and the vote by which they can kind of signal a peak. But we do get that vote split for the Bank of England, and so we may well see it's not our base case, but we may well see the most dovish members start to vote for a cut, even perhaps. And that would probably be, if anyone, Tenrere. I'm not sure that the market will pay that much attention or be that bothered if she does vote for a cut. She's, a well-known dove and anyway leaves the committee very shortly. She has only a couple more meetings that she will vote at. So I'm not sure the market will kind of place much weight on her voting for a cut, but certainly, you know, some members voting for bigger hikes and some members voting for a cut would represent quite a dispersion of views on the committee. I think, you know, it's interesting to me that when we recorded this podcast last week, I can't remember exactly what I said, but I'm sure I was complaining that the market pricing was much too hawkish for the Bank of England. And we just did, you know, done this roadshow of meetings and everyone was telling us how dovish we were. And actually now it feels like the market's adjusted so far in the other direction that pricing for next week feels a little bit low to me, particularly after the ECB have hiked 50. You know, the market's still only kind of pricing in 50% chance of a 25 bip hike from the BOE next week. Which feels low. I think probably a bit further out, the pricing becomes more fair and in line with our kind of view that, you know, a peak here and rates remain on hold. But I do still think that, you know, only 50% chance of a hike next week feels like low odds to me, especially after the ECB. But let's see. Let's stop there. There's so much we could talk about, but like we've kind of alluded to already in this pod, lots of moving parts and everything seems to be changing on a day-to-day basis. So I'm sure we might be looking at a completely different world this time next week when we catch up. But I'm sure there'll be lots to keep us busy between now and then. So thank you both for joining me. Thank you to our listeners for tuning in. And just a reminder, if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.